Hi, this is Jim Cunningham. I have Christina Lindsay with me. Today, we are going to talk about life insurance basics, navigating coverage with confidence. Now, I don't know about you, but I have life insurance, and my wife really prompted me. She's like, if something happens to you, what's going to happen to me? And that's frankly why I think a lot of people buy life insurance. Really, this isn't about you because you won't be here when it pays out, right? But this is about the people that you love and you care for. And we're going to go through the different use cases for life insurance, and we're going to talk about how much do people need. And when I say you, there's no attorney-client relationship. This is not advice, certainly. This is just to understand insurance and really the basics. So if you're watching this on YouTube, please subscribe to our YouTube channel. You can click the subscribe button, and if you click the bell, you'll be alerted when we drop new content, which is typically 6 p.m. On Thursdays Pacific time, and we do these live. So if you're if you go, wow, that I'd like to ask questions, not in the YouTube comments, but you can go ahead and put those in the YouTube comments. But if you'd like to join us on our webinar, you can go to our website CunninghamLegal.com, and there's a link in the notes here if you're watching this on YouTube, and you can watch this live. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for now over 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, which means I've taken an extra bar exam after the normal bar exam, as well as peer reviews, and certified by the state bar as an expert in estate planning. I'm also insurance licensed and securities licensed, as well as a pilot single engine land instrument rated, although I'm not current. These are the lawyers in our firm. We are dedicated to all things peaceful transfer of wealth from one generation to the next, and family protection, protecting the people you love, protecting the people you care about. And part of that is life insurance. And we're going to talk about that today. With me, I have Christina Lindsay Orta. She is a certified financial planner from Ascent Wealth Management, and she is one of the 3 principals at Ascent Wealth Management. And she is here to share some very valuable information. This is our legal disclaimer. I'm a lawyer. I'm talking. This is not legal advice. So if you're watching this on YouTube, or you're watching it live, or you're driving to Montana for the summer, as a good friend of mine is driving to Montana right now for the summer, then this is not legal advice. Okay, this is hopefully a little bit fun, and certainly, Christina, now I will pass the mic to you, as it were, and you can go through your disclaimer.
Yeah, this is our legal disclosure. We are an independent financial advisor. We have a registered investment advisory firm with the SEC. We also have a broker-dealer, and then we also have insurance licenses with the state of California and are licensed in many other states. So this is not seen as investment advice. As Jim mentioned, we would have to do any recommendation on a one-on-one individualized basis.
All right. I think the big question here, Christina, this is the first question. Once it's like, yes, life insurance is for me, how much is enough? And I think this is, to me, the hardest question.
It is the hardest question. And, it changes at various stages of your life. And so the general kind of ballpark starting rule of thumb is you need 10 times your annual income as a replacement. So if you were to have 10 times your annual income and you're close to retirement and you have enough for your retirement plan, then obviously this rule of thumb would change. But while you're in your earning years and you're, more than a decade away from retirement and you don't have some significant assets to cover your lifestyle needs, if there was an income replacement from 1 or 2 spouses, then you would want to make sure that you're having insurance to cover 10 times the loss of income. Then you'd want to tack on, if you have children, an additional 150,000 per child for college. And then you really have to factor in how much debt and income, and do you have mortgage debt or education that would need to be funded? So these are kind of general rules of thumb, is to figure out how much are you going to need. And if you know what you're going to need, let's just say that you're newly married and you're going to have children, then you'd want to try to get as much as you can afford to earlier, because life insurance never gets cheaper as you age. It always gets more costly. Ask yourself for sure who depends on you financially. Is it going to be your children? Is it going to be your spouse? Is it going to be a parent? And how would your family cover those debts? Sometimes there's one spouse that might even stay home and be a homemaker, and you would have to cover the cost of a caregiver. So sometimes people go, well, there's not going to be really an income loss there if they were to pass away. Do we need to cover them? Well, the question is, how much would it cost you to have a caregiver so that you can go still earn money for the family if there was a loss of life? So,
Christina, that reminds me. I spoke to my cousin years ago. I was talking to my cousin and her husband, and I was like, how much life insurance do you have? And my cousin, who's the wife, he goes, none. I'd be ahead if something happened to her, which I think is a kind of a joking way of saying it. But I mean, this is a real issue.
mhm.
And a lot of times that you have a working couple, so both
Yep,
spouses are working, and that works if because you have two spouses that are working, maybe they're sharing the parental roles. But if one spouse does pass away, that may just be too heavy of a lift for the surviving parent. I mean, setting aside all the other issues about losing a spouse and losing a parent
correct.
when you're a child, that is something really that I think people don't really think about enough. They're thinking about, well, what would I miss in terms of income wise if this person left? But that's a very good point about the childcare. And childcare, by the way, for those of you who have not had childcare lately, is it gotten cheaper, Christina, or has it gotten more expensive?
It's quite costly. It's not inexpensive by any stretch.
Yeah.
And then I think the other last bullet point here is my employer provided coverage enough? That is a really important question because oftentimes, if you're able to get what we refer to as group coverage, so it's typically less expensive to get some coverage through an employer because it's group rated, meaning if you might have a particular health condition, that might not be as relevant when you're getting the policy through the employer. It might cost you less because the insurance company isn't rating you differently for having some pre-existing conditions. That being said, you might be limited on what you can get through an employer. And if that policy is not portable, if you were to leave that employer, the question is then what do you do if you're underinsured and don't have that policy? So I think that that's a very important question. Coverage at each stage of life, it's interesting because these are very general rule of thumbs because there was actually a speaker that wrote a book and he spoke last week at a conference I was at, and it's called Why I Find You Irritating in the Workplace. And it was really it was on the generations, the boomers, the Gen X, the millennials, the Gen Z, and just the differences in each of these generations. And the underlying one of the underlying points that he drove home was if you were to look in 1970, the of five criteria for an age 30-year-old. At age 30, what was the percentage of people that had graduated college, become financially independent, bought a home, got married, and had a child at age 30? And in 1977, it was 77% of women and 65% of men. And in 2010, the last real concise census data that was provided was showing around 13%.
Wow.
And so that's really where this conversation of life insurance is different because people that might get married in their 20s might not get married until their 30s, and just your life stage is different. So again, keep these ages as just kind of a guardrail. This is not necessarily going to be specific. But in your 20s and 30s, you might have final expenses. You might have an income replacement. You might have a spouse that you would have to care for, and you might have children.
What are final expenses? Are you talking about like funerals? Yeah, yeah,
Burial,
right.
funeral. Yeah, exactly. But some people in their 20s and 30s do have um, the replacement cost of a caregiver, homemaker, and a mortgage. So that would be kind of like if you die, having a term policy to cover those main things. In your 40s, 50s, and 60s, it becomes probably what we refer to as your go-go years, where you've got significant income replacement. You might have a larger mortgage. Maybe you've upgraded homes and moved up and taken on more debt. You've got kids for college to plan for. And having a permanent policy could mean that there's cash value there to borrow against the cash value or pull some of the value of the policy out while maintaining a death benefit. Then you also have to be mindful of a business buy sell. So if you have a business partner, then there's a particular need to, what if I lost my business partner? I had to buy out their family. Do I have the cash to do that? And so having a business buy sell and for continuity of your business to go forward, making sure that there's money there to either replace that business partner and the role that they played, or to buy out the family from that business.
Yeah, I'm really glad you put this in the slide deck, Christina, because this business buy sell, the probability of it happening is not great, but the disaster is and can be really huge. And if you have to buy out a business partner, let's say you're 50-50 on a business that's worth $10 million. I'm just bringing out a number. That means you would have to buy out the partner for 5 million. That is a lot of money, and that may mean closing the business. That may mean having, the relationship that you had with this person, with their surviving spouse, being very soured, or their family very soured. So this is a real issue. Some people, their buy-sell agreement is as simple as this last man or last woman standing gets it. Other people fund it with life insurance. But this is very important to pay attention to that if you have a business of really any kind of value. I would say a million and above is where you really need to pay attention to it. Is that what you would say, Christina, if you have a business that's...
Yeah,
Yeah.
absolutely. Absolutely. And then when it comes to 70s and beyond, that's really where you may be obtaining a new life insurance policy for purposes of legacy creation, or if you have estate tax exposure. So we can talk about some of those other reasons, but more often than not, what we're looking at in 70s and beyond is converting an existing policy to possibly add additional benefits. Maybe your need is not necessarily income replacement. You're now in retirement, you've got sufficient assets, but maybe you might have the need of long-term care. So we're looking at a policy conversion possibly.
I will say, as an estate planning note, because we're an estate planning law firm, and if you're a hammer, everything's a nail. So I'm always looking at the estate planning side of this. Life insurance passes by beneficiary designation. And this is really, really important, because your life insurance does not go in your living trust. I'm broadly speaking, okay? That beneficiary, who gets that money when the person who is insured. So if I have a life insurance policy and I die, it doesn't matter what my living trust says. It matters what the beneficiary designation says that is on file with the insurance company and that the insurance company can locate. So how often should you be reaching out to the insurance company to verify beneficiary designation?
Anytime that I would say on average every 5 years, but anytime that there's a life change, absolutely. So if there's been a death, if you've changed your trust, if you've disinherited someone, if whatever the change, if you've gotten divorced, you definitely want to change the beneficiary designation and review that more frequently. But if there's been no major life changes, 5 years is kind of a good rule of thumb. So types of insurance. Term insurance is the least expensive form of insurance. And that would be, anything through your employer would automatically typically be a term policy that will be covered so long as you're employed, unless you have a specific other type of policy through your employer. And the term could be 5 years, 10 years, 15, 20, 30. If you're typically your rule of thumb there would be is if you have a 1-year-old, or if you're going to continue to have children, you want to have a policy that will last until your youngest child is age 22, so that they are out of college. They may not be fully self-sufficient, so you might want a policy that's a little bit longer, maybe a 25-year term if you were having your youngest child today. So term policies are going to be the least expensive. They're going to probably cover that, largest nut of income replacement or debt that would occur if there was a loss. There is a form of convertible term. to where, okay, maybe you can't afford to pay for a permanent policy today because those are more expensive, but you have the option without having to be reinsured. And that's the important component is maybe you're healthy and you've got no health concerns today, but then 10 years from now you know that you've got health concerns. Maybe you had a cancer diagnosis, or maybe you had a heart concern or a stroke, and you want to get more coverage. You could convert that term policy without having to be reinsured. And so there is an option there to sometimes look at that. You're paying a little bit higher premium when it's convertible
Mhm.
than you would if it's not a traditional, if it's a traditional term policy.
And I know, I mean, how much, because this is a question, the how much question. And by the way, if you're watching this and you're asking yourself how much, I think that is a totally legitimate question because people don't know enough about life insurance. And sometimes the only thing you know to ask is how much, right? You
Yeah.
need a whiz bang. You're like, okay, well, how much is that?
Yep.
You're a 30-year-old. How much is $1 million term life insurance? I see it advertised on TV, but what are we talking? $50 a month, 200 a month, $10
Yeah,
a month?
it depends on if it's a 20-year term
Yeah.
policy, for $1 million and a healthy 30-year-old, it's typically not going to cost more than $500 a year. Um,
500 a year, which sounds like, what is that, $35 a month or I don't know, $40,
yeah, and
42 a
again,
month.
these are generics, but
That's like 7 lattes.
yeah, yeah. The earlier that you can afford to get permanent, that the wisest thing that my father did when I got married, and my husband and I were in our 20s when we got married, but we got permanent whole life policies on each other. And that would not cover our needs today because our needs are much different than they were in our 20s. But at least we have a permanent policy of some sort. And it's not always this is how much you should have of one type of insurance. We know we've got a certain amount of permanent, and then we also have to bridge that gap of what are we unfunded for if we were to have a loss, we would need to bridge that gap with term. Sorry. So we would need to make sure that we have term coverage to bridge the gap.
And then permanent. So permanent is, I explain permanent to clients as not term. It's
Correct.
everything other than term. So it's really, you could say term and not term, meaning it is not limited or constrained by a term of years. And that's what that term means, a term of years. You are buying a 10-year policy, you're buying a 20-year policy, whole life, universal life, variable life, pay out at the end of your life.
Yes, they could be cash value accumulating.
Right.
They could be designed to not really build as much cash value because maybe you're not looking at ever using the cash value. If you're ever looking at using the cash value for retirement income purposes, then it's a different type of permanent policy. It could be dual purpose. So there are some that are designed to really accumulate cash value. There are some to be designed to be the cheapest form of permanent coverage. There are some that are guaranteed to age 100. There are some that are guaranteed to 105. And then there's some that are just purely whole life. So this does have some variance, and it would take some time to figure out what is most appropriate for your needs. But those are all different forms of a permanent policy.
And we had one quick question here. Anita asks, I may have missed something, but is it wise to make the trust the beneficiary, for instance, on a protective life insurance instead of other beneficiaries? I would say it really depends on the situation. It depends on who the beneficiaries are. If they're young beneficiaries, if it is a lot of times a family with young children, like under the age of 18, typically the spouse is the first beneficiary, then the trust is. The reason for naming a person rather than the trust as the beneficiary is that is potentially subject to your creditors, right? So if I leave my life insurance to my living trust, that death benefit it's a long path, but it is potentially subject to the claims of my creditors, where if I pay it to a person, it is less subject to my creditors. If it goes to my spouse, there's an argument that it still may be subject to the creditors of the community property, if you will, or my separate property. But I would say it's a case by case basis. But what do you generally, you're seeing people leave it to their spouse, then the trust,
Then the
right? Yeah,
contingent being the trust, and
trust.
largely because, if you leave it to the trust too, it could get tied up for
Yeah.
120 days. Like if sometimes people might even leave it directly to their children so that they're not having to wait for the trust administration period to then get the distribution. They're able to have some proceeds then at that moment. So it just depends.
So whole life, I think about it as like a bank account. It's like a CD return, right? It's getting a 4% or 6% or 3% return, kind of a fixed guaranteed return. Is that what you're seeing with most whole life policies?
Yeah, most of the time they're not geared for real cash value accumulation. They're there to have a protection for the entire duration of your lifetime so that it will have a death benefit that never goes away.
In terms of an investment and growing, is it better than a universal or variable life, which are,
Universal
yeah,
and variable tend to be more cash value driven to where
okay.
there's dual purpose there, that they could have a death benefit and some potential ability to use that cash value in a tax-free manner as a loan against the policy during your lifetime. So it just depends on the goal, and there's not a right, wrong answer here. It's just depending on what is in the best interest of the client, what is the cost, because sometimes whole life could be very costly, where a universal life you're reliant, or a variable life you're reliant on the underlying investments that the cash value is tied to. And if they're invested in mutual funds or things that are going to be maybe a little bit more aggressive, you're taking a little bit more of a gamble there, where your cost could be less if the market performance is good, but if the market performance is not good, it could require your premiums to go up. So there is some degree of, you know, volatility there.
More risk, basically,
More
is what you're
risk.
saying. Yeah, yeah, more risk. Um, it's another aspect of life insurance. In terms, you were saying investing in mutual funds. Life insurance is an income tax-free zone. So what that means is you're not paying income tax. You know, when that money comes out and it's paid to the beneficiary, you're not paying income tax. If you take a loan, you're not paying income tax. I guess the exception would be if the thing collapses and it becomes something called a modified endowment contract, which if you're paying attention,
Correct.
that should not happen. So very
Correct.
tax efficient. By the way, life insurance predates the Internal Revenue Code.
Hmm.
Came before taxes.
Yes, it did.
Came before the IRS in the United States. Okay. Term policies.
Yeah, so I would say that coverage for a specified number of years, it could be 10, it could be 5. I mean,
Mhm.
we've done some business transactions where, if you were to buy out a retiring partner, for example, and you've got a loan that you owe, revenue to that, former partner, business partner for a period of 5 years, you might only get a 5-year policy to cover that specific need. So again, you could get coverage for 5 years, you could get coverage for 10, for 15, for 20, for 30. That's kind of your typical range. And so I know, again, personally, for example, at age, 35, I think we got another 30-year term policy for my husband and I to take us until our retirement years, to really bridge that large income gap that wouldn't be satisfied with a permanent policy that's more expensive. That's going to be the cheapest form, just to make sure that we're covered during our working years and while we've got kids until we're age 65. And so sometimes it makes sense, if you can afford to get a 20 or 30-year policy, the earlier, the younger you are, the healthier you are, the cheaper the policy is going to be.
Just
You
don't
could
go
look.
on that cruise when you're 64, Christina. Kidding.
Um,
All right.
the level premium, actually, it was, I won't make a joke about this. We were in Sedona hiking to the top of Bear Mountain 2 weekends ago, my husband and I. We got back down to from the bottom of the top, and one of the guys that does tours in the that area in Sedona said there was this guy and his wife got in a fight, and he pushed her off the cliff a year ago. And I'm like, oh my gosh, you got to be kidding me.
Oh my God.
So
Wow.
don't know what
A
the
question
policy
here.
was on here.
This is a quick question. Will term insurance pay overseas beneficiaries if you're without a spouse?
If you're
So
with,
the insured is a U.S. resident. The beneficiaries are not U.S. residents, U.S. taxpayers.
Mhm.
I mean, I don't see a problem with that as long as there's not a restriction on capital. I mean, if
As
they're,
long as there's no
oh, yeah,
AML, it's not like a country that can't have money sent to it if there's a
I'm
money
sorry, I
laundering.
spoke over you. Unless there's anti-money laundering issues,
Correct.
so you would have to deal with that separately. So if it's and there's a list of countries that are kind of on the naughty list, if those people live in those countries, you would probably have to do estate planning within the United States, naming those people as beneficiaries. I'm not quite sure how you would do that, but
Yep.
yeah. All right.
Yep. And then level premium during the term policies typically have level premiums, meaning if your premium is $500 a year, it's going to stay $500 a year for the term. Now, sometimes when those terms go beyond their term, there is a renewable option to where you could say, okay, I'm now in year 21 of a 20-year term policy. If it's renewable, the company will tell you, you can keep this policy, but your new premium is going to be X. And so if you know, hey, I'm terminal, I am not able to get new insurance, but this is a renewable policy, and I know my life expectancy is pretty slim for very much longer, you could choose to pay that continued premium to keep the policy in force.
Right.
So I think that that is important to note. And then potentially looking at converting the policy, you'd always want to price that out. Is it cheaper to convert the existing policy, or is it cheaper to get a brand new policy? And that's where the analysis of a professional would make sense.
Yeah. So what Christina, what you're talking about is, let's say you do like a 20-year level term. It's $1,000 a year for 20 years. In year 21, they'll still insure you, but it might jump to like 8,000 a year or 15,000 a year or whatever. But if you're terminally ill, it makes sense to pay it. If you're not, most people, I think, don't pay that, right? They just get another policy or they don't get insurance.
Mm-hmm.
Right. Okay. Pros and cons. It's cheap. It's
Yep.
simple.
Yep, term is inexpensive. And again, this could be stackable. So maybe you have a 30-year term that you got, 10 years ago for 2 million, and now you need another 2 million. Well, you don't need it for 30 years. You might get another new policy for, another 2 million for 20 years or for 10 years. But it might be cheaper to get a new policy than to just get a whole brand new $4 million coverage. If you need, double the coverage, it might cost you more to get a full brand new policy for that term. It might make sense to stack these a bit. The cons of term is it is use it or lose it. So it's like home insurance. It's like car insurance. If you never need it, there's no value there. There is no cash value accumulation.
Yeah. And then some people say, I don't believe in insurance. I mean, what they're saying is insurance is not for me. Not that they don't believe it exists, but some people say, what's the logic on that? Is it?
I don't know. I know people really struggle with, I
If you're
can't.
struggling with mortality, I mean, that's part of it. And
Part of it, and just the cost of going, nothing's going to happen to me. And I'd rather just have that money to use for my lifestyle than to pay it on insurance. And I'll tell you, that's really where the earlier, the better, the sooner, the better to get coverage. True story. We have a dear family friend that just passed away at 48 years old after an 8-year battle at 40 with colon cancer, and left behind 4 children. Fortunately, the youngest are in high school to where it's not going to cost a whole lot of daycare. But, if there could have been coverage issued before age 40, then there'd be something. But at 40, she became uninsurable.
Yeah, I meet with a lot of people, and I'm getting older, and the saddest. This is kind of a downer topic. The saddest thing is when people are just beginning their retirement and somebody gets sick and dies. And you and I have mutual clients that's happened to, and it's really a bummer because somebody you may have spent your whole life with, you're really looking forward to retirement, and somebody gets sick and dies. And life insurance is a lot of times they've passed their term, right? So you might have this gap of, you might have gotten a 30-year term when you were 30, and now you're 60 or 62 or 63 and somebody passes away. So I think it's really important to revisit this, even if you're in your 50s, right? You may want to look at it. You may want to look at it. I'm not saying you do it, but it's something really to look at because you just don't know what's going to happen. All right.
Well, and maybe you're underfunded for retirement. Maybe
That's true.
you're 5-10 years away from retirement, but if something were to happen to you in that 5-10 years, you'd be significantly leaving a spouse, very underfunded. It might be expensive, but that might be something that could make or break your retirement plan, or make a surviving spouse have to go back to work or work an extra decade. So
And
it is something to look
that's,
at very closely.
Christina, that's really important because something that I think people don't, it's like if you think about it, you're like, oh yeah, I didn't realize that. But if you're banking on 2 Social Security checks and it drops down to 1, that's going to cut your income, and that's gone. I mean, all those payroll taxes you paid, you're not getting that back from that one spouse. Now there is a survivor benefit that's really been throttled back. But I think broadly speaking, banking on Social Security in retirement, I know for the last 30 years, financial advisors, since I've been a lawyer, have said don't bank on it because it could change. Who knows?
Hmm.
Permanent policies. What are we
Yeah.
talking about?
And right before we get into permanent policies,
Yeah.
the only other thing that came to mind in thinking about term is sometimes we will use term. You mentioned Social Security, and if one spouse were to pass away, sometimes people have a pension that the greatest pension benefit is to take the full single life benefit to or have it reduce to like 50% if one spouse passes, where the pension is reduced so that there's more available to live on in retirement if you take the higher benefit now. Sometimes we will analyze supplementing that with terms so that, if something were to, God forbid, happen to one of the spouses in the first 10 years of retirement and that pension benefit got cut in half, there's a term policy to bridge the gap.
Yeah.
So that is another component of term and why we would use term to kind of bridge the gap. Now going on to permanent. Permanent is a lifetime coverage. When properly maintained is key. Permanent policies require, and I will underline that, require analysis with in-force illustrations. Annually, most insurance policies will provide an in-force illustration saying, hey, this policy is in force, and this is illustrating how it will continue to perform if we only have the guaranteed rate of return, if we have the average rate of return, if we were to have a 4% rate of return on the cash value. So it's important to understand, is the policy performing as it was intended? And that requires revisiting a permanent policy on a regular basis. I have looked at old policies where clients were supposed to be paying XYZ premium. Maybe they cut back those premiums a couple years because they had financial troubles and they never picked them back up. Now the policy's at risk of lapsing, or the policy has underperformed expectations and it's going to require a couple additional premiums to keep it in force till age 100. And alternatively, maybe the policy is overperforming to where we can scale those premiums back. And so it requires a review. And we may even want to access some of the cash value via a tax-free loan. Does the policy offer long-term care benefits? Those are things that we want to look at. Mhm. So again, use would be to have permanency, to have possible access to cash value, to have predictability. Maybe we have a potential estate tax exposure issue where, I mean, Jim and I have both had clients where they might have, let's just say someone has a $20 million estate and 15 of it is tied up in the business value and real estate. And if all of a sudden there's an estate tax due, how do you do a fire sale on the business or all the real estate to cover the estate liability? A lot of times people will fund that with insurance.
Yeah, that and this is really important. I said earlier that life insurance is an income tax-free zone. That is true. What is also true is if you are the owner of the policy,
Mhm.
it is included in your what we call gross estate. So it's included in your taxable estate. So if you like for Christina's example, if you have a $20 million estate and a $1 million policy of life insurance, if that life insurance is owned by you when you die, that extra $1 million is included in your estate, subjecting that $1 million death benefit to a 40% tax. So what a lot of people do is they will not own the policy. They'll be the insured. So their life will be insured, but they are not the owner of the policy. And the two big options you have are having some other human or humans own it, not your spouse, maybe your kids, or to put it into an irrevocable trust. An irrevocable trust. We'll be talking about that on our next webinar on June 19th about irrevocable trusts and what's going on, the difference between revocable and irrevocable. But that is a special purpose trust. It's also called an irrevocable life insurance trust. We used to see those, Christina,
All the time.
a lot more. When I started practicing law, the estate tax exemption was $600,000. So everything above 600,000 was taxed at up to 55%.
Correct. Yeah.
Crazy high taxes. So lots of people had $1 million policy in an irrevocable life insurance trust if they had a $2 million estate or $3 million estate. Now with the exemptions as high as they are, currently they're about 14 million, 13.99 million. Maybe they'll drop to 7 million next year. Maybe they won't. This is what they're talking about now in Congress, is getting this bill passed to keep that 14 and maybe bump it to 15 million. But we
Hmm.
used to see those a lot more. And if you have an old policy that you're still paying on, you really should pay attention to that. And I would recommend you reach out to Christina because she can take a look at that and run an in-force illustration, which I would say, Christina, broadly speaking, most insurance professionals aren't doing this enough for their clients, right?
That is correct. And
Right.
then the other, very, very rare case, but unfortunately we've seen it and we both know someone that had an irrevocable life insurance trust policy. It was funded, it was performing. However, the insurance carrier that was holding that policy was now entering a poor credit rating, and that insurance carrier went into receivership. And that
Which is
meant
basically bankruptcy for
an
a
insurance
insurance
carrier, yeah.
company. Yeah. Yeah.
It meant that the state came in and limited all benefits to 300,000. Didn't matter if you had $1 million policy, a
Yeah.
$5 million policy. It was limited to 300,000 is what they were coming in and saying that's all that the bank can afford or the insurance carrier can afford based on their assets and all the policies that were outstanding. So another important part of the review process of reviewing if that policy is in good stead is who's the carrier? Is it a small insurance boutique company that has been around maybe since the 70s or 60s, but is not creditworthy anymore? It
Night,
would
you
be
mean
wise.
nightlife? Hold on. Are you saying nightlife of Cuba? That was a law school example, nightlife of Cuba. So
It would be wise to get that money out while you can before it goes into
right.
receivership if you're starting to know that they have difficulty. So it's a very rare case. When you're dealing with big insurance carriers that have big names, they're going to have a lot of credit rating transparency. They're going to also have Comdex scores, which is really important to understand their ability to pay claims if every policy came due. What's their financial standing to pay those claims? That is important if you have a low level small insurance carrier. It would be worth reviewing that. So universal life does have flexibility. It could be an indexed universal life. It could be a variable universal life. Indexed means it's typically going to be if your cash value, for example, is 100,000, that cash value, if it's an indexed policy, might be tied to like an S&P 500 index where it's capped at say 8%, for example. So if the S&P 500 is up 10%, you're going to get up to 8. If the S&P 500 is down 10%, you're going to have zero loss on your cash value. So you're going to have a little bit more guardrails, but no risk of loss that could erode the cash value of the policy. Then you could have a variable policy where the underlying investments are invested in a basket of mutual funds where you're not capped on your upside, but you also have downside risk. So if the mutual fund performs at a positive 15%, you'll see that positive 15%. If next year's down 15, you'll see that next year's down 15. So there are some different types of universal life policies. Again, there is not one size fits all. And then the con being it requires ongoing maintenance to make sure that it is performing as intended. Is it underperforming? Is it overperforming? But you have flexibility. So if you say, okay, I want to overfund this during my working years, I want to put in $10,000 a year of premiums, or $500 a month until I'm age 65, and then I don't want to be using my retirement money to pay this. I want it paid up. I want it done. You have that kind of level of flexibility. Or if you have 2 years where you're laid off during your premium periods, you could choose to not pay premiums for a couple of years if there's enough cash value to maintain the policy. So universal whole life, they do tend to have different levels of flexibility.
Christina, what if somebody moves to Cabo? Let's say they go, you know what? I'm going to move to Mexico. I'm a resident of Cabo. I've got my place in Pedregal.
Mhm.
We have a client with a place there, and
Mhm.
it sounds pretty nice. It doesn't get hot in Cabo in the summer. They're like, well,
Yeah.
we're on the Pacific side. It's like 20 degrees cooler.
Yeah.
So they're in Mexico and they want to get life insurance. Can they get life insurance through you if you're a resident of Mexico?
It depends on the carrier, but sometimes we can as long
Okay,
as you're a US citizen. So again, it depends. Mm.
good. Existing policies. So if you're a lawyer watching this, because we get a lot of lawyers on here, actually estate planning lawyers, when a client comes in with a policy of life insurance, I really think you're not doing your job unless you recommend that they have that policy reviewed with a competent life insurance professional. And this is really, really important because we've been able to save people from some pretty bad disasters and really improve their position on reviewing an existing policy. So I'll let you talk about this and the importance of it.
Yeah, so I think we've talked about making sure that you're reviewing that they're performing if you have an existing permanent policy, but you also have to review your needs. Have your needs changed? Has your life events changed? In the example I gave of a dear family friend where she's passed away at 48, if he passed away, the loss of income for the kids and having the mortgage debt and all their needs have changed because there's been a loss in the family. So have your needs changed based on death, divorce? Have you upgraded your home and bought a new, home with a higher mortgage that would straddle your family with a larger debt if you passed away? Have you had a significant increase in income? So maybe you bought policies, 5 years ago, 10 years ago, and you've gotten pay raises over the years. And if that income went away, it would be a significantly greater hit to the household. So those are things that you definitely want to be mindful of. And then legislative changes, estate tax exclusion is a big one. So how much is the estate tax exemption? Again, we were kind of teetering on this at the end of the year. Is it going to go from, 13 million per person to 7 million per person? And so will you have a potential estate tax exposure is the bigger question.
The other thing is we are based in California. So we tend to think about, we're very California centric.
Mhm.
However, if you decide to move to Oregon, anything over $1 million is taxed at up to 16%. If you
Yep,
move to
they're
Washington, anything over a little over $2 million is taxed at 20%. Other
correct.
states have state death tax. So even if you have a $5 million estate, if you're an Oregon resident and you have typically a permanent policy of life insurance, you're really going to want to think about putting that into an irrevocable trust. And we can certainly help you with that. The other thing we haven't mentioned is some states, I know Louisiana protects 100% of the cash value of a life policy from creditors. So
Hmm.
California has very weak creditor protection. It's about 13,000 is the current exemption.
Hmm.
So
Mhm.
another reason to use an irrevocable trust is also for creditor protection. So if you have that policy of life insurance, that a creditor, that's potentially seizable by the creditor, right? So, but if it's in a policy, if it's in an irrevocable life insurance trust, it gives you creditor protection. So there are reasons to use these irrevocable trusts beyond tax planning, right? This would be essence.
Correct. Yeah. And it could be very much state specific laws.
Sure. All right,
So,
this is great. I think a lot of people don't know about this. This 1035 exchange, this is Internal Revenue Code Section 1035. For those of you who are familiar with real estate, there's Internal Revenue Code Section 1031. That's where you can sell one piece of
mhm,
real property, buy a replacement property, right? And there's a whole process for that. Well, you
mhm,
can do this with life insurance policies and annuities, right?
correct. Yep. So if you have an existing life policy, so you can always go in the 1035 part of the Internal Revenue Code, you can go from a life policy to another life policy if it's permanent, not term. I mean, term, you would have to have it renewable or convertible. But if you're exchanging one life policy with cash value, you could exchange it to another life policy. You can go from a life policy to an annuity. You cannot go in reverse from an annuity to a life. And so, but if you have an existing life policy that has cash value and it has a permanent death benefit, we could look at multiple options. Option one, we could look at exchanging that policy for a new policy that has possibly either more coverage for the same amount of premium because maybe your cash value has outperformed. Maybe we've
Mhm.
had good market appreciation. Maybe it's a variable or an indexed policy and that cash value's grown and it actually would cover more coverage today than it did when you first bought the policy. Or we could look at taking, the same amount of coverage and lowering your cost of premiums. We've done that for some clients to where, again, maybe it's been a decade that's passed, maybe it's been 20 years that's passed. You have this policy and you're going, let's take a look at if we could get more or less or pay less. Or we could look at even having a paid up policy. Maybe you've paid into this for 20, 25 years. You're retired. You're going, I don't want to keep paying these premiums. What if we were to just make this a paid up policy where we have the same amount of coverage, we're done paying premiums, or we're willing to take a little bit less coverage, not pay premiums. So there are options that we can do a proper analysis. We could also look at living benefits, meaning we could look at adding a long-term care rider where it allows you to use your death benefit tax-free without having to liquidate your IRA and pay taxes or without having to sell the home and pay capital gains. It allows you to use and leverage the death benefit of your policy during your lifetime to cover in-home care, assisted care, or memory care, any kind of a long-term care event. So again, maybe you've had this policy all these years, you've put money into it during your working years, you really needed it to cover income replacement, but now you're set. You've got plenty of assets for retirement, you've got your legacy wealth transfer covered, but you really are concerned with long-term care. You could convert that policy to cover a different need. Annuities also could be used where that could be used for retirement purposes. So sometimes people go, well, why would I want an annuity? Well, maybe you've got this life policy you don't need. You paid into it all these years. If you cash it out, you're going to pay tax on the gain. So we could do the 1035 tax-free exchange into an annuity and repurpose that for possibly better tax efficient retirement benefits. So we just want to look at what your needs are and just know there is options with existing cash value policies.
I'm reminded of the mutual client we have, and we were able to do a 1035 exchange on a policy that kept the same benefit, death benefit, but eliminated a $6,000 a year premium.
And added long-term care benefits.
And added long-term care benefits. So that was a big deal. Like $6,000 a year, that's a lot of money.
Mm-hmm.
And the great thing, well, the reason behind this is they changed the mortality tables. Basically,
Yes.
people started living longer. And this is very important to understand. If you took out a policy of life insurance 20 years ago, that is a contract that is governed by the terms of that contract.
Mm-hmm.
So unless the insurance company agrees to take less premium, which, spoiler alert, they are not going to agree to do that. Okay.
Mm-mm.
That is the use case for a 1035 exchange. So you say, we're going to go from company A to company B. Could you also be in the same company and do a 1035 exchange? I think you could, right?
Possibly, yeah.
Possibly, yeah. Right. Great. Good stuff.
Yeah. So, as we kind of wrap it up here, the uses for life insurance is for ensuring, income replacement, children, tuition, daycare, uh, business seed money for, if you potentially wanted to provide an option for passing on a legacy for your family business, tax diversification, again, tax-free loans, supplemental income. It could be a way to overfund a tax-free or tax deferral beyond qualified retirement plans. And so that is an option used for retirement income. It could be used to fund education planning as well for children. Business owners, again, key person protecting, if there was a risk to the business, if one person was this, primary person that business is dependent upon, and then a buy-sell agreement to ensure continuity of the business. High net worth families, estate planning, coverage for estate tax, again, not just federal, but could there be a state estate tax, as Jim mentioned, if you live in a state that's, Massachusetts, Oregon, Washington, those that have estate tax exposure. And then looking at gifting, whether it be charitable or wealth transfer.
A lot of different ways that life insurance is used. And it's not for everyone, but when it's appropriate, a competent advisor is going to recommend it, whether you go to Christina or somebody else, because there are these sort of classic use cases where we see a lot of life insurance. Wealthy families use a lot of life insurance. Okay.
Yep. And when we're talking about charitable, it's more of an income tax planning.
Yeah.
If people are charitably inclined to pay taxes to their charity of choice, as opposed to having the IRS or the Franchise Tax Board be their charity, they might choose to do some tax planning and fund a charitable trust. And sometimes people go, well, gosh, I put the money in a charity and then it's not there for my kids. Well, you could take a tax benefit for, putting money into a charitable trust, but then do an insurance policy that would replace that legacy value for your family. So we've done other webinars on charitable trusts, and that is sometimes where insurance comes into play, is doing a replacement of what would have been gifted to the family through legacy in the estate. We might have given that to charity and we want to replace that. So that's where insurance comes into play as well. And then looking at captive versus true independence when it comes to.
What does a captive agent mean?
Mhm. So that's going to be your big firms where the agent is an employee of the firm. Um, there are sometimes, for example, New York Life or Northwestern Mutual. I could, as a general independent agent, place the insurance with New York Life if I felt that was best, but I'm not captive to them. I'm not employed by them.
And
So,
captive means you can only offer what
yep,
they allow you to offer. It may not
I
be with
work
that company.
for.
It could be an affiliated company, but it's a very limited list, right?
Correct. It could be, I work for XYZ firm. I'm only limited to offer you XYZ insurance products. So even, for example, when my father, used to work for Edward Jones way back in the day, even at Edward Jones, he was not captive to an insurance company. Edward Jones was not an insurance company, but he was only able to offer limited amounts of product that was on the shelf of the broker dealer, because he was an employee. He was not an independent financial professional that was a fiduciary that had no conflict of interest to go out to the broader market and say, what are the best insurance carriers that are out there that would insure my client? What are their needs? And I want to provide whatever's the best, highest quality A-rated insurance carrier that would meet the needs of my client, where I have no conflict of interest because I'm not employed by XYZ insurance carrier. So I think that is incredibly important to make sure that you've got not just a regular insurance agent, but a fiduciary that also happens to be insurance licensed, that's looking at what's in the best interest of the client and not beholden to sell what they are employed by.
And I will say that this is a very competitive market. And in working with you, Christina, on clients, I know you go through a general agent, and the way life insurance works is the life insurance companies deal with general agents who then deal with people like Christina. So it's a layered system. She's not going directly to the window of XYZ insurance company or whatever it is. You're
Mhm.
going through a general agent. Um, the What I like about this is you're able to look at top quality companies, and the same policy terms have different pricing.
Mhm.
Now, can you explain why that is? Why does ABC company, why are they higher than XYZ on a given day? Is it just their,
Yeah, it
what's
could
going
be
on?
that XYZ company has too much risk on their books for the rest of 2025.
Mhm.
So they want to limit their amount of policies that they add to their books. So they're going to make themselves uncompetitive for the rest of the year. They're going to say, hey, our price is going to be $600 a year versus $500 a year. We know we're more expensive. We need to limit our risk, and we don't really want to issue too many more new policies. And then it could be that come 2024, okay, we now are ready to take on more risk. We have an appetite for more risk. We can be more competitive. We want to capture more market share. We're going to lower our premiums to $450, for the same policy. So it just depends. It really depends on the underlying insurance risk of that carrier, what their credit risk is, what their appetite is to take market share. And when you're using a general agent, we can look at what is the most competitive in the landscape this particular time. It could be at this particular quarter, or if we've got a pilot, for example. There are certain insurance carriers that are just more competitive at not costing an extra premium just because you have an extra insurable risk.
So I would say, I mean, I'm insurance licensed. A general agent to me is the way to go. I mean,
Yeah.
I don't
Mhm.
really see the captive agent why you would do that. So, But again, that's just my opinion. So
Mhm.
this brings us to the end of our materials. We do have questions. So if you're watching this on YouTube, you're going to miss these questions because we don't post them. If you want to ask questions, I highly recommend that you check out our website and you register for one of our webinars. So we have offices in Northern and Southern California. This is Ascent Wealth Management's contact information. And next time, we will be talking about trusts unpacked. Navigate your options, revocable versus irrevocable. When is it good to use a revocable trust, and when is it good to use an irrevocable trust? Great topic. Now we will open it up for questions. Again, if you're watching this on YouTube, keep watching because another video is going to roll right if you've made it to the bitter end. And we'll see you next time.